Hello, Greg Kuda.
Hey, Mike, how are you?
You, you were rocking the Cavs today, man.
Yeah, go Cavs. Got at least one Cleveland team is on the winning here and doing the right thing.
Oh my gosh, I'm having some issues, by the way.
Yeah, yeah, yeah. Your
Um,
team looks like the Browns there. So
wow, is it wild to sit back and watch? Like seriously, I'm almost stunned. And then you listen to the radio broadcast, and the two guys are trying to come up with something good to say, and struggling mightily, I must say.
yeah, no, I'm in shock and awe with obviously the Packers, then also the Vikings so far. I didn't see that coming.
That's the coolest thing about the NFL is that it really levels the playing field with that salary cap. Um, you can't just go buy a team essentially, uh, and you look at the teams that get to the playoffs and generally win the Super Bowl. They're healthy. They don't have a lot of injuries, and it's just everything goes their way that year.
Yeah, no, without a doubt. I mean, obviously the Rams stacked it last year, but you look at this year versus last year, they're really not that much of a different team on paper. But you would never know that the way that they're playing this year versus last year. It's just night and day.
Yeah, and if you analyze a game, there's just like you can generally pick a couple plays that change things. A dropped pass here or there, obviously a fumble, turnover, something like that, tipped ball. Um, People have been saying Rodgers is having this bad year and he's getting all these balls tipped. That's because the linemen aren't really blocking their guys down. Their guys are able to get their arm up in the air and
Yeah, no, it's you could say the same thing with Tom Brady and Tampa, where I mean, statistically, he's doing extremely well, but you would never know that by looking at their win-loss record, where all those little things either add up in your favor or you continuously snatch defeat from the jaws of victory, and
you're right.
that's the big difference from being 3-5 and 5-3. It's probably 9 to 15 points collectively. So.
Yeah, I think you're probably right. All right, so lumber. Things are a little weird. We're in a transition point in these with this contract.
Yeah, yeah. I think it's funny when you look at um, the CME open interest, the daily bulletin for open interest, and just to see the options gone for the legacy contract now, it's literally just the top third of the page, and then everything else is just blank. Where, for all intents and purposes, you either have to trade the mini options because the legacy options are officially gone. So it's just to see that physically, it's a striking difference. Where, yeah, I mean, I hate to. I know a lot of people are obviously for the new contract, but there are some people that don't want to embrace it and think you're going to somehow go back to continuing to do things the old way. And that's just get that out of your head. Like, it's either you're not going to trade lumber or you're going to trade the mini, but that's kind of what this is snowballing into, is that if you want to trade options, you got to do it on the mini. So it's going to happen. It has to happen.
So the same sort of thing happened when they put the mini S&P on.
Yeah, yeah.
So many. Why would I trade the mini when I can trade the big and it's 4 times as much? There was a lot of pushback, and then you look today, and the mini S&P is the benchmark contract of all futures.
Yeah, no, it's pretty funny. I couldn't even tell you. It's probably been early 2000s since the last time I actually traded a real S&P 500 versus the mini. I mean,
Well, the real's gone. Like it
is
doesn't
it
exist
officially gone? Yeah, there you go.
because it was only pit traded, and
It's right. Yeah, well, there you go. Yeah. I mean, it's out of sight, out of mind.
So
Uh,
it's that change is a 4-letter word for some people. So
yeah,
it's, but it will. It will happen. All right, let's get into
Ready to
this
rock
here.
and roll here?
Let's rock and roll.
So,
Uh,
just kind of starting big. The big difference, obviously, or maybe not so obviously, is that we have our elections today, midterm, and you're seeing the headlines: "Fight for your democracy." This is a watershed moment for our democracy. So, again, this is my 2 cent analysis. Equities have been on a tear here the last day and a half. Dow, S&P, Nasdaq. And I think a lot of this has to do with the idea that you're going to see a lot of blue areas go red. You're going to see the shift from Democratic to Republican, and the likelihood of the current administration kind of losing control of at least the House and the Senate. And I'm not trying to be political, but that's the market's take right now, that you're going to see this shift from what is to back into the red, the Republicans' hands. And the markets historically, and I've got another slide here, like the idea of this change here. The status quo isn't working, so equities to me are, buy the rumor. We'll see if we get the sell or a continuation, but it looks like buy the rumor in anticipation of a sea of red here later today and tonight with the results.
well, and I think Elon Musk put a tweet out recently
Mike, give me
saying,
1 second. Hang on 1 second here.
not a problem. Well, what I saw is Elon Musk tweeted, "Vote Republican," and wow,
Okay, sorry about that.
what I was saying is Elon Musk tweeted, "Vote Republican," and if you stop there at what he said, it sounds very endorsing the Republican side. But the reality is what he said was, with a Democratic president or Oval Office, if you have a Republican Senate, it causes gridlock, and historically, gridlock in politics is good.
Yeah, no, and that's here. I'll come back to this, but you could see, and I didn't draw it here, but you could see this downsloping bull flag right here. So the market again is trying to break out to the upside on the S&P. The objective is a retest of this 3930 area up to the 4020 area. And this could happen in the next couple of days. This could happen pretty violently, pretty quickly to the upside if you break out here, especially with midterm results kind of shifting to red. So this is something I would definitely look out for to the upside. And I think lumber, all markets, and you're seeing it in gold today, especially, where all markets could be the beneficiary, where you get some upside potential here in just about everything.
And there's some changes happening in inflation. I just
Yeah.
read wholesale prices for used cars is down 15%, and like that's going to make an impact on the inflation number.
Yeah, and so the expectation when you look at CPI, so we have the CPI inflation read tomorrow. My guess is it'll be lower than what they're forecasting, not higher. And so then the market, that should be a good tailwind for the market as well. But we'll see. I mean, those numbers are hit or miss, but just kind of doing an internal analysis. I have one guy that I trade with that is phenomenal. He's a phenomenal technician and kind of looks at the BLS and all the numbers in his forecast, and just looking at the numbers is going to be a lower read. So the market should be encouraged by that. But here's, and I literally just put this in the slide deck 5 minutes before we came on live here. So I'm kind of looking at this for the first time too. But, this is equities, treasuries, S&P 500 during unified and divided government versus, here's S&P, here's government bonds, and you can kind of see different administrations, kind of what the market has done. So it'll be interesting, and I'll have more on this next week. I was kind of searching just to see historically what this means, but a divided government isn't necessarily a bad thing, like you referenced, Mike, as far
Correct.
as upward mobility and equities here.
Don't let them get anything done.
Well, and that's the issue is, people have to realize that, okay, you shift to red. Okay, they don't officially take office until January, so that just basically, realistically, are you going to try to push through stuff before the end of the year? If not, it just sets up when you've got a divided House, divided Senate, divided, not in line with the president. It just kind of sets up the current administration for a lame duck final 2 years, where it's just Washington gridlock at its finest, where not a lot gets accomplished.
Yep.
Let's see here. So the other big thing that you're seeing is dollar, and the dollar is down sub 110 today. So the beneficiary of a lower dollar is
Now, hang on just
appreciation.
a second. When you
Yep.
say down 110, that's the dollar index, correct?
Yeah, I'm sorry. That's the dollar index. I'm looking at dollar futures, the dollar index, which equates to a 110 threshold.
And it's basically just matching it up against a bunch of other currencies.
Yeah, exactly. A dollar index is just a basket of other currencies. Exactly.
Perfect. Okay.
And so the thing that jumps out to me is that, we peaked out in this 114, 115 area. And now that you're sub 110, the beneficiary crude oil is down a little bit today, but crude's been able to trade back up to, yesterday it traded just south of $94. And then the big one that jumps out at me today, you're up over $100 in gold now over the last 4 trading days, where you could see this big move with the red line, that's gold. You could see the big move with copper. So as the dollar tops out, that's good for commodities. So the idea that you can have your cake and eat it too, as far as an appreciation in equities. Well, guess what? If you're going to get that appreciation in equities, you're probably going to get some appreciation in physical commodities. And so, this is probably something the Fed hates to see, as far as, the last thing they want to see is commodities starting to trend back higher, equity starting to trend back higher, because it kind of defeats everything that they're trying to accomplish. So I think you could get your seasonal rally, your Santa Claus rally in equities, but I would be very skeptical in chasing the momentum, because it's just going to further resolve the Fed to continue to do what they're doing. That they want to annihilate inflation, and that is going to be in the crosshairs for the foreseeable future. So here's oh, am I there, Mike? Did I cut out, or am I back?
You're all good.
Okay.
You're all good.
So gold is up 6.3%. It's up 2.5%, I think, today. And you could just see commodities back in vogue here over the last 5 days, where, cotton, silver, nat gas, a lot of kind of staple type items are trending. And a lot of this coincides with the fact that the dollar has kind of topped out for right now.
Well, something makes sense there. I mean, it's cheese, milk, and cocoa are all up. So it's winter months. We're going to be having fondue and hot chocolate, evidently.
Yeah, that's right. That's right. And then here's the losers, and unfortunately, Lovable Lumber here has kind of gone sideways to lower. Wheat at the bottom here, there were issues with Russia saying they weren't going to agree to a wheat distribution in the Ukraine. They backed out of it for like 48 hours. Wheat spiked, and then once they decided they would come back in, wheat collapsed. So that's kind of why wheat's kind of leading the charge here to the downside.
Yeah, it has quite a bit to get back. It was rallying pretty strong.
Yeah. And so we look at treasuries. So the other thing of note, especially with equities, the fact that you're really not seeing these big pullbacks in treasuries here, whether you're talking the short arm or the long arm of the curve. You're still well up over 10. You're still well up over 4% on the 10-year. And then when you look at 30-year mortgage rates, I just kind of kept the same numbers over the last couple of weeks. Look at your 30-year fixed with the 700 credit score, 7.8%. 30-year fixed FHA, 7.52. These are up 1/4 of a basis point really over the last 7 to 10 days now. So rates are certainly not Typically you get that inverse relationship where equities rally, rates kind of pull back, and you're not seeing that so far here. So the market's kind of pricing in the fact that we're going to have higher rates, and equities are trying to live with it. And so when we look at 30-year, here's from Federal Reserve of St. Louis, Fred. Here's 30-year rates on an historical basis, and you can see, you're obviously back above 2006 levels. You're really at that point now where you're back at 2000 levels on 30-year mortgage rates. And again, just to put this into perspective, when you look at historically 30-year mortgage rates, I think your 7.75% is the mean type average mortgage rate. So all you're doing is reversion back to the mean. It took a while to get there, but you're back to those mean type price levels on the 30-year mortgage rates. And so this is from Leonard Kiefer, Freddie Mac. 2022 is the banner year as far as look at the year-to-date change in 30-year fixed mortgage rates by year. You haven't had a year like 2022. I mean, this is the greatest change from trough to peak here, and we're still not done yet. You can still make the case that we're still trending higher in 2022.
What year? Jump back just real quick. What was the red year? Was 1980?
Yeah, red year is 1980, so we're mimicking 1981 here so far.
Okay.
And so kind of going back to the inflation, and again, we'll have inflation tomorrow, CPI, Consumer Price Index. So big picture updates, the meaning of 8% inflation. So historically speaking, here's the red line is the US cycle. Black line is the Eurozone cycle. So this is from 1920, 318 observations, 1950, 220 observations. History suggests anyway that, once you get up to the 8% inflationary type number, you're going to start to trend in the opposite direction. You're kind of reaching the zenith of inflation where, again, you could go sideways indefinitely. But the idea that inflation can accelerate from here, history shows that's going to be easier said than done.
Agreed.
So
inflation is an inherent way of stopping itself.
Yeah, exactly.
I mean,
the cure for higher prices is higher prices because eventually you just, you get the demand destruction.
I went out for breakfast on Sunday morning, my wife and my son and I, and it was just to the Greasy Spoon down the street. And I was just shocked at the prices. It 50% higher without a doubt.
Yeah, and I've got I agree. I mean, it's you go out and then it's the sticker shock is kind of wearing off because it doesn't matter where you go. You're going to spend, to go feed a family of 4. It doesn't matter if you're going to your local diner, you're going to Chipotle, or you're going to a sit-down restaurant. You're going to drop some coin regardless of where you go now.
Yeah, absolutely.
So the next chart here, time to stop chasing the Fed. Peak monetary. Look at the monetary amount of money in play here.
Percent of the world's central banks hiking rates.
Yeah.
In other words, this is all hands on deck. Everyone's doing it.
Yeah, everybody is chasing the Fed. The Fed is the leader of the pack. And so, again, we're trying to export our inflation, and everybody else in tandem now is trying to raise to kind of deal with their own inflation. So it's just, pretty amazing that this bottom right here is literally the beginning of 2022. So here's literally, this is in 1 year, which is just insane.
Yeah.
So, we're going to jump into housing, but here's CPI versus wage growth. So you can figure out which is which. You'd rather be this red line, but unfortunately, this is what when you go out to the restaurant, when you're buying goods, this is what you're paying inflationary wise, and then this is what you're getting paid. So there's a big disconnect there still. Ideally, we'll start to see a convergence here at some point. but kind of factoring in what the Fed is looking for, the other big part of inflation, the other part outside of inflation is labor participation. They want to start to see more unemployed people. And from a percent standpoint, workforce participation, you're finally starting to see, here's the pandemic, you're finally starting to inch back. Again, this is a nice little bell curve where if there's no pandemic, we're probably at 64 to 65% labor participation. You could see we're not even back to pre-pandemic levels. So there's still a massive divide gap of people not participating in the workforce. And so that's kind of counterintuitive to what the Fed's looking for, where they want to see less people participate. They want to see the unemployment numbers grow, but you're still at a big deficit to where you're either going to start creating less jobs before you start to lay people off. And we know layoffs are coming, but there's still a big divide versus, jobs available to the actual people out there. That's still got, that gap is still has to close here.
I think as we let more people into this country, that gap's going to close.
Yeah, absolutely.
If you're letting someone in the country, they're not here to come and lay around because it's too expensive. They're coming here to work.
Yeah, no, I think the vast majority of people still see this as the ultimate land of opportunity and just want a chance. So when you look at residential construction employment, unemployment rate, historically you're about as low as you can go. And, I guess what you're going to start to see now as residential builders continue their slowdown, the workforce has got to go somewhere. And, if you're a specialty trade, tradesperson, you're just going to see that shift away from residential into the multi. But the idea that now you're as far as labor participation here, these people don't fall off of trees. So you've kind of still maximizing what's available right now when it comes to home. When it comes to construction, residential, you're just going to see that shift from residential into multi.
They might fall off a roof, but not out of a tree.
Yeah. And so, this was from the New York Times. I think this was over the weekend. And you can see, this is just compares homes for sale. So, trying to make the comparison with housing this year versus 2007, 2008, 2009. We're nowhere near in a situation where you're just going to have this massive flood of existing homes come on the marketplace. We're still a massive deficit of homes needed for people to live in. So that's the one positive, is that we just you're unlikely to see this big build of homes on the market because people have to live somewhere. So it's great if you can sell your house and capture top dollar here, but you're going to have to realistically refinance a 3.5% mortgage rate to 7.5 plus, and you're going to still pay, whatever you're going to get as far as home price appreciation, you're going to have to pay for that. So don't expect this big flood of homes to come on the market here.
Interesting. My sample set of one friend of family, single. He and his girlfriend were going to move in together and consolidate, and they couldn't. With the move up in interest rates, the home just didn't sell. So now they're not going to live together.
Yeah, no, I think that's I have, same thing. I have an aunt that lives in Glen Ellen, the Chicago area. They put their house up in the fall and then just took it down. It's like, okay, like we can probably sell it, but what are we going to do? And nothing was obvious. Let's see here. So grocery store.
Grocery, yeah.
Yeah. So we've definitely seeing a peak in grocery prices, food prices, but you're still 30.8% higher than you were in September 2020. So I mean, that's just so destructive from a wage growth standpoint versus your cash outlay to live. I mean, everybody, just the basic necessities, items to live. I mean, this is just catastrophic to somebody's pocketbook.
But I'll bet most of that pullback is in freight cost.
That's a good point. Yeah. No,
and
I think that's.
I personally have been shocked. I looked up a couple of freight rates today, and they were easily 30 to 40% lower than I thought they would be.
Well, that's funny. Just like lumber, somehow the sawmills like to raise their freight prices, but when they come down, has anybody gotten a freight reduction yet? Yeah, somehow this doesn't translate to the end consumer. Let's see here. So, the one positive thing here, October's apartment rent cuts rank as the third deepest since 2010. So that's a positive. You can see the other two are obviously pandemic related. So you are starting to see a stall. You kind of referenced rental car, or I'm sorry, not rental car, used car prices earlier. You are starting to see a stall now in rental prices, the ability to increase rent, raise rent. So again, people have to live somewhere. So if you can't buy a home, you have to rent. And so this is encouraging that you're starting to see potentially signs of rental prices topping out and then starting to pull back here. And you're going to see this obviously a lot faster than you would see mortgage rates or a monthly house payment to buy a house. This is going to be much more receptive to month over month changes to pull back here.
But rents are still
Yeah. You're pulling back from the moon, and that's the problem.
From a demand creation for lumber. High rents equal more multifamily.
Absolutely.
Like if you're a multifamily developer right now, the numbers point to let's keep knocking up buildings.
Yeah, no, and the other big thing people have to remember is that when we had the subprime crisis in 2007, in that time frame, that's kind of where you created that flood of homes where people lost their homes and you had all these homes hit the market. Well, a lot of the rental properties out there now are Blackstones, are the big private equity where they did not buy these for land price or home price appreciation. That's the ultimate goal. But the revenue stream, to kind of break even and make money is that 3, 5, 7 year window where we're going to buy this and rent this out, and that's the revenue stream. So these markets are these houses are off the market for the foreseeable future because it's all about getting that rent check. It's not a function of that home price appreciation. It's all about that rental, to generate that revenue stream through the rental itself. So big picture updates. So this is again from that New York Times article. If you want to move, this is where the listings are piling up. So Phoenix, Raleigh, Nashville, Austin, Tampa, Las Vegas. Something tells me just because there's more listings here doesn't necessarily mean that the cost of living, I would doubt that a lot of this stuff is single family, first time, entry level homes where I would have to imagine that, yeah, there's more listings, but this is probably a higher, it'd be interesting to see, what level of houses are these entry level? Are these middle of the road? Are these more luxury type listings? So here's the high end. And then if you're looking to move to these areas, good luck because you're not seeing an increase in the listings here. You're actually down.
And I look at the right side there. Those are very mature markets.
Yeah.
Those are some old towns. So it makes sense that.
Yeah, you're not getting a lot of new construction versus, this is obviously a lot of newer construction versus the right side. Absolutely.
Yep.
Let's see here. So I showed this last week, kind of inflation, year over year change in building materials. And so it kind of goes into, a year ago, we talked about difficulty getting engineered wood products, getting OSB, getting, more wood based materials. Now, if you're building a house, these are the biggest inhibitors by region. And you can see the vast majority of stuff is kitchen appliances, windows for whatever reason in the Pacific Northwest, and then cabinets in the Northeast. But, a lot of this, has very little to do with actual, you're not going to have a difficult time finding wood to build a house right now.
No, I know where you can get some.
Yeah, yeah, right. So let's jump into lumber.
Lumber. All right.
Here's our weekly continuation again. We're kind of tried to break out to the upside of this. This would be a weekly bull flag kind of. You can make the case that we're definitely trying to bottom, and we'll look at the open interest here for greater detail. So here's the other weekly continuation chart, and again, you've got this coil formation. Again, tried to break out once. We'll try to do it again here. Really, you're going to need to get above. This is your 9-day moving average right here. This is your 20 up here. So if you can get back above 500, you can take out these highs from a weekend or 2 weeks ago, then that kind of gives you a bigger upside objective and back into the 600 plus. But it's, obviously it's going to be easier said than done.
I can, that move we had a couple weeks ago, it had a lot of hope in it. The momentum felt like, oh, this is the one. And wow, it just died out quickly.
Yeah, no, I mean, it was pure and simple. It was just the funds getting pushed out and you just didn't have the fundamentals. You didn't have that new, again, if you're going to, you want to support a move back to 500 plus, it's got to be on a building open interest structure. You're not going to do it on a declining open interest structure because eventually you just run out of people to stop out. So if you want the market to break out here, it's got to be, you got to see open interest build to support this.
Right. It felt like the buying that was pushing that up was a lot of, oh, I've got projects for far enough out. These are good levels. I'll buy, but I'm not chasing it.
Yeah, no, absolutely. Absolutely.
And we're kind of seeing the same thing here. It seems like at least this week, the trade for materials exchange has been happening on the bid, meaning if you've got an offer out there, people aren't lifting the offers. Everything's trading down into the bid.
Right. So when we go into the daily chart, I got to spend too much time on Nove because it's we're in the spot month. You're still, I was kind of asking people yesterday and then this morning in anticipation of the show today, Mike, give me where's cash, and I heard stuff on 4-inch anywhere from 435 to 475, depending on the mill, depending on the Eastern versus Western. Legitimately 4-inch seems to be, out to the end of this month. 6-inch is a lot tighter. The band reference there was a lot tighter, but that sense of urgency, really doesn't exist. I mean, people are going to do what they have to do and then go away. And so, technically speaking, when I look at the January contract, you made a low here and then were able to close higher on the day. You had 2 follow-up days now where, again, here's your 9-day moving average. Ideally, you get back above the 9-day, which is the 450 area. But, when you look at kind of these 2 days here, the positive thing was you saw a build in open interest, specifically in Jan, where we came off the low end of about 1850. We're back over 2,500 right now. And predominantly that build is in January. So that's at least constructive to say that the market's trying to bottom out. You had a reversal back to the upside with building open interest.
2 days ago, that's contract low.
Yeah. Yep.
I mean, those are, to me, those are important levels to keep an eye on. Like at contract lows or at contract highs, there's nobody that bought that contract that is in the money.
Right.
So you can sit back and look.
So the one thing, I'll also add to that is you see the Bollinger Bands here, kind of just floating. This one's trying to float a little bit lower, but at 2,000 open interest, ask yourself, are you really going to get a breakout underneath these lows that's going to be long-lived? Are you going to see a build of open interest sub new contract lows? I guess maybe. The reality is you're running stops down here. The second you get that sell pressure to subside, you get this reversal back to the upside. And so the reality is, you want to look at, what's the outlook for lumber. You're stuck, just look at these Bollinger Bands, 545, the old high here, the low is 412.10, to 382. I mean, you're going to be hemmed in this 545 to 400, maybe a 380 area for the foreseeable future. You're just going to float back and forth. And if you want to narrow it from there, you could say, well, anything in this 478 to 500 area, the market's really going to have to do some work to suggest that it belongs higher right now.
It's the new selling, or selling is forced selling, not opportunistic selling.
Yeah. And so no, Jan, again, I'm not going to spend too much time here just because the illiquidity. You're probably stuck in the 17 over to 6 under area, and it just, is contingent upon who's got to get out on any given day. Jan, March, I think probably represents a good opportunity to front spread Jan, March kind of in this range.
The Jan March is going to be an interesting one. We sit back, and I think we can all agree demand's not the savior of the market from, driving it higher. It's going to be supply coming off.
Yeah.
And the supply's got the best story possible. We've got holidays coming up. We're going to do upgrades, maintenance, whatever. They have every opportunity to kind of get away with it with their employees because
and I know it's a delicate balance, especially if you're unionized, that you don't want to publicize the fact that you're not going to be operational and people conceivably will not be working. But I would highly suggest, if you want to get the leveraged full benefit here, then if you're a sawmill, don't be afraid to, if you can do it, publicly announce the fact that you're taking shutdowns, even if they're cosmetic. From a market psychology standpoint, the market wants to hear that there are more shutdowns. So when we look at, we're 400, this is daily continuation futures, yearly average. So right now we're 460, you can kind of throw out the last 2 years, and you're kind of in the middle of nowhere here, where you can make the case you're where you belong right now.
If you just take your hand and cover up the last 2 years, it looks pretty normalized.
Yeah, absolutely. And so, again, seasonally, we know we should be bottoming. You're basically, you're right here right now. So for all intents and purposes, we should be bottoming to trend higher into the end of the year.
That's a pretty powerful chart right there.
Yeah. No, and again, the last 3 years is obviously going to, when you look, you're going to take these 2 years. So that's very influential. But, seasonally, even on the long term, the 7-year, 10-year, 15-year, 20-year averages, this is historically the best buy of the year is into this time frame. So we'll see if that plays out. I'm not going to spend too much time on the curve because basis, you can see you're pretty much there with November. You're there with January. You're basically there with March. So all this tells us is that if you need coverage for Q1, it's okay to accumulate in the futures market. Build out your inventory here. You don't have 100% cash outlay. And then as the jobs come due, you simply just release the futures and go buy the physical cash.
Yeah, I mean, everything is really pointing to a sharply sideways market. And it's choppy. Some people will call that. If you're forced to do something, you're going to be forced to trade on the opposite side of the market that you want. Meaning, if you're a buyer and you have to buy, you're probably lifting offers. If you're a seller, you have to sell. You're going to hit bids. The play here is to be nimble, I guess. I think if you drew the line right through the middle of the range and say, look, if I'm a buyer, I want to be buying below the middle. If I'm a seller, I want to sell above the middle.
Yeah, no, absolutely. I think that's a great way to look at it for sure. So open interest, obviously we're seeing a slight build, which is positive, especially if we're trying to bottom out here. You want to see this build. Not a lot of Novembers left. The EFPs have been lackluster so far. as far as CFTC commitment of traders, these guys came in, got stopped out. Unfortunately, you're just losing everywhere, which again, this is reflective as of November 1st. So, again, to be sustainable, you want to start to see really builds with producer longs, and then ideally you'd see the managed money, these continue to decrease and this continues to increase. That becomes much more sustainable to support a bottoming structure.
I look at this and I say there's a lot of dry powder on the short side. When you look at the 249 shorts on the industry,
Yeah,
um, if we were to see any sustainable rally, there's many entities that can sell into that.
Yeah, no, and this is again the hope. We hope it higher, and so far the hope strategy hasn't been the best strategy. As far as we hope it back to 600, we hope it back to 700, and now we hope it back to 500. We hope it back to 550. So I agree. There's a lot of dry powder here that doesn't want to sell below a certain number, and I will say though, just from my own book of business or what I'm seeing out there, the hope has been higher all along. I can genuinely say now, Mike, that there's just as much hope as far as hoping it higher versus hoping it lower now, where people do want to buy these pullbacks in January and March. There's much
Yeah.
more
Yeah.
interest to start to accumulate back month futures, January and beyond, in both legacy and the mini contracts. So that's encouraging, and that the buy paper is finally starting to show up now.
I think what you could sum that up is there is liquidity. It's just lower. You have to go lower to find liquidity from the buy side.
Yeah, and so everybody wants to buy a certain number. Realistically, you rarely, when everybody wants something, they rarely get it. So it'll be interesting to see if people raise orders or are willing to chase, and any type of appreciation in the futures market. Time will tell. So I just want to quickly. I'm sorry. Go ahead.
I've been working on several long-term deals, and the buy side is interested in these prices for extended periods. Maybe all year.
Yep.
Sell side's like, maybe, I don't know, a little bit. So yeah, I think we're darn close to the floor.
Yeah, no, and I think the sell side, better days ahead. And so speaking of the sell side, here are the monthly Canadian and Euro softwood lumber exports to the U.S. numbers. These literally just came out today. So you can see year to date, BC Interiors down just under 7%. Canada as a whole is down 5.84%. Interestingly, in the last 3 months, you have seen an increase in BC Interior shipments to the U.S. And then when you look at just Canada in the last 3 months here, you're only down 1%. So there's been this big shift, but realistically, I think we know that demand is not a horizontal line. Demand is probably still a downsloping line. So the reality is we've had a decent chunk of production supply come off, but we probably still need to see more come off. And so when we jump into, here's Canadian lumber exports to the U.S., you could see you're kind of, and again, 2020 was your pandemic year. So you're definitely lower than the last year, kind of lower than pre-pandemic. But it's not like you're seeing this massive disconnect from where we've been over the last 5 years. And so this is kind of by region in Canada. BC Interior, still reflects a big downtrend. Again, is what you need to see. Again, you need to see this go down, but then you look at, kind of some of the other regions, there really isn't that dramatic of a shift out. Even Alberta's down, which is encouraging, but everywhere else is just kind of flatlined. So Europe, this is again year to date. So this one kind of shows it better. We're still outpacing exports to the U.S. from Europe are still up year over year. And again, no big surprise here with the exchange rate, where this is a pretty lucrative market in the grand scheme of things. So I
Well,
would
and
expect this year to exceed last year from an export standpoint.
my sources are telling me that even, exchange rate aside, there's no market in Europe.
Yeah.
They got really no other place to go with their wood. And they're quick to switch. I mean, they're all waterborne shipments, so they can kind of go anywhere in the world.
Yeah. And again, I think the hope strategy for Europe is less staying in Europe. It's probably that at some point China re-engages, and then that would be a lucrative market. Same thing for BC or just Canadian, West Coast Canadian crowd at some point that maybe you get a resurgence in Chinese demand, but we're just not there yet.
Yes, and that is my black swan or wild card is China.
Yeah.
I mean, when's the last time you even that came up in a conversation? And what was it? Maybe 10 years ago, 8, 9 years ago? It was always, oh, China's in buying. China just bought.
Yeah.
So
Yep.
I have a friend who
they would take a mill off the market, or OTM. We sold it. It all went to China. Yep.
I have a friend who does business in China, not in the lumber industry, and they're still shut down. I mean, it is still zero COVID policy over there. There is not a lot going on. If that changes, when that changes, because it will, that could be the wild card. I mean, we sit here and we say that demand isn't going to be the savior. Well, what if we're wrong? Well, what if China comes back and is the savior for the market from a demand?
Yeah, no, you wonder how much of this is political with China as far as teaching everybody a hard lesson versus, okay, we can't come back on because we just don't have the medical infrastructure. You're going to get this the zero COVID policy. Their vaccines are much less effective than our vaccines. So it's intriguing to say, at some point, does China just flip the switch and turn it back on? And that is the ultimate wild card. That could be a very positive for everything. That could completely alter where we're kind of headed right now if China just decides to turn it back on here for whatever reason.
Yep.
And then the other thing to continue to watch, and again, I'm not really hearing this, from collectively but just the idea that rail continues to be significantly slower into the U.S. Canada looks good, but once you cross the border, U.S. rail seems to be sloppy, getting sloppier. So, the earliest that they would strike, there's still no resolution as far as the U.S. rail. The earliest they would strike would be after the elections. I think it's somewhere around November 19th, but we're in November, so it's something to watch as we grind through this week into next week.
Got it.
And other than that, Mike, that's it. I'm headed to Phoenix here, so if you're going to be in Phoenix the next couple of days, definitely reach out. I'd love to see you, and we'll kind of see. My big takeaway is just let's watch the midterm elections tonight, and if we do get that shift to red, I guess that's a very positive tailwind for not only equities, but could it be for a lot of different markets. And then above and beyond that, CPI tomorrow, CPI Wednesday, and then PPI next Tuesday.
Yeah, and my read is sharply sideways. Whatever's going to drive this market one way or the other is a bit of an unknown right here. The knowns are out there, and they are pointing towards sideways.
Yeah, no, for sure.
All right, Greg, excellent presentation as always. We'll see you guys next Tuesday. We'll, I'm sure, have some takeaways from the NOLA show. Next Tuesday is expiration of November.
Yep.
We already saw if you are in those contracts, it gets dicier and dicier every day. Be careful. Rely on your professional broker.
Yeah, no, my only suggestion for those still in November, unless you're taking it or making it, do something every day. Do not wait to the last minute. Good, bad, and different. Do something every day. And
we're going to keep our eyes open for basis opportunities. Nothing here today, but that changes quickly.
Yeah, I appreciate it. Thanks, everybody. Thanks, Mike, as always.
All right.